Home sales increased by more than 10% in both Travis County and Williamson County during June.
Is that units or volume?
Let's talk about that.
Okay, well that sounds like a housing market that's picking up steam, doesn't it? But at the same time, local lenders are telling us that mortgage applications are falling, pre-approved buyers are going quiet, and July activity has slowed down pretty dramatically. So is the Central Texas housing market gaining momentum, or are the buyers starting to pull back?
Then I would say both.
Both. So welcome back to our monthly Central Texas real estate market update. I'm Russ Phillips, and this is Tanya Kerr, and we're the best.
He's right though. So this is where we go beyond the headlines and explain what the market is actually meaning for both buyers and sellers, homeowners, and of course anyone who's considering moving to Georgetown, Round Rock, Austin, surrounding Central Texas communities.
So for this month's report, we're combining the latest June sales data from Unlock MLS, that's our database, with insight from 3 local lenders that we know, trust, and love working with.
That's right. So Christina McQuett with Fairway Mortgage, Parker Couch with Barrett Financial, and Steve Ferguson with RWM Loans. Now, all 3 are seeing the same change in the market, but they're seeing it in a slightly different angle. So let's dig into that. When we pull their observations together with the local sales numbers, one thing becomes very clear. And what is that, Russ?
This market is being driven by the monthly payment, not the price of the home.
That's right. So let's begin with the June numbers because on the surface, they look very strong. So Travis County recorded 1,441 closed residential sales during June. And this was an increase of over 10% compared to the previous year. In units. The median sales price increased 2.9% to $535,000, and the median time on market fell to 31 days, which is 5 days faster than it was 1 year ago.
And that's Travis County.
That's right.
And the price per square foot also increased slightly to $324.
That's a lot.
That is a lot. So the total sales volume exceeded $1 billion, which was up more than 16% from the previous year. It's also worth noting that Travis County had a significant amount of higher end activity. That's really what's driving a lot of this. Nearly 1 in every 5 sales during June closed above $1 million.
1 million smackaroos.
What is $1 million anymore?
I know.
So that helps explain why the average sales price was more than $753,000, while the median was $535,000.
Pulling that number right up.
Yeah.
So for most buyers and sellers, the median price is generally the better representation of a typical transaction because a smaller number of expensive sales can pull the average up much higher.
Yeah, we actually pulled that off ourselves in June with the second highest recorded residential sale in Williamson County history.
Yeah, boom.
So that's a good segue into Williamson County. So the story's a little different there. Williamson County recorded 1,068 closed sales during June, which is an increase of 11.3% from the previous year. So just like Travis County, more units actually closed, but the pricing numbers were softer.
So the median sales price declined 1.1% to $420,000. The price per square foot fell 2.6% to $204 per square foot. And the median time on market actually increased 7 days to 42 days on market. So Williamson County had more transactions, but did not necessarily translate into more pricing power for sellers.
So what was driving that? What would you say?
Well, homes were selling, but they were selling to buyers who took more time, compared more options, were being more selective about what they were willing to pay, and usually that's that monthly payment.
Almost 65% of Williamson County's June sales were below $500,000. That's important because this segment of the market tends to be particularly sensitive to changes in mortgage rates and the monthly payment, like you said.
A quarter-point change in rate may not completely change the decision for every buyer, but for a household already close to its preferred payment, it can absolutely affect whether they're going to move forward or whether they're going to take a step back.
So let's talk about why a strong June sales record and slower July can actually both happen. Here's why the timing becomes important. A closed sale is a rear view mirror indicator. So many of the homes that closed in June originally went under contract in May or first part of June, possibly even late April.
Yeah.
Okay, and that lines up almost perfectly with what Parker told us at Barrett Financial. Parker said that May and June were extremely strong for both mortgage applications and closing. And then July fell off sharply. That means that the June sales report is not necessarily describing what buyers are doing today. It's showing what buyers were committed to several weeks ago.
Mortgage applications and lender pipelines give us more of an immediate view of what may be entering the market next. So we would call that a leading indicator.
Yeah. So when June sales are up while current mortgage applications are falling, the numbers are not contradicting each other. One is looking in the rearview mirror, one's looking forward through the windshield.
That's right. They're showing us 2 different points in the transaction cycle. Now, Christina McQuett with Fairway Mortgage has been closely watching inflation, bonds, and the mortgage-backed securities market. She explained that the latest consumer and wholesale inflation reports came in cooler than expected. So that gave the bond market some relief and helped mortgage pricing improve after rates had already moved higher.
But Christina's warning is important. One encouraging inflation report does not automatically create a long-term downward trend in mortgage rates. We all know we've been willing mortgage rates to go down. Investors want to see whether lower inflation can be sustained over several months. And energy prices, geopolitical uncertainty, Federal Reserve commentary, employment reports, and future inflation data can all move the bond market and therefore move mortgage rates. And that can happen quick.
That's right. Christina described investors as being cautious but somewhat relieved, and that's probably a good description of the housing market as well. There is relief when rates improve, but buyers do not yet trust that those improvements are going to last. The latest weekly mortgage data Christina shared showed that the average contract rate was rising to approximately 6.65%.
So that was the highest level since last August, although it was still slightly lower than it had been at the same time last year. So what does that mean for buyers?
Well, it means that we may continue to see windows of opportunity rather than one steady and predictable decline in rates. So when they go down, jump on it.
Yeah, you got to be poised and ready.
Yeah.
You got to be in the starting blocks.
That's right. You got to know what you're looking for, know what's the inventory's out there, and be ready to go. Or buy it down. Just make the offer and buy it down.
Okay, so now let's talk about what Parker Couch is seeing. Parker with Barrett Financial is seeing the effect directly in his pipeline. Nationally, overall mortgage application volume fell 2.7% in the latest weekly report, while purchase apps fell about 7%. Parker also pointed out that purchase applications had been running ahead of the previous year throughout much of the spring. So we had high hopes early in 26.
Well, and our numbers showed it too.
Yeah. Now, for the first time during that stretch, purchase activity has slipped below last year's pace. And the most important part of Parker's feedback was this. It's not that they can't qualify. They don't want to lock at these numbers, and so they wait.
That's right. And that is a critical distinction. So some buyers have not been completely removed from the market. They still have the income, the credit, and the available funds to qualify, but they just don't feel comfortable with the payment at the current rate. And so when rates move higher, those fence sitters become quiet. They stop scheduling showings, they delay writing an offer, or they decide to wait till another economic report comes out and hope that rates will improve. So that means the demand is still there, but it's definitely paused, and it's highly cautious, and it's extremely rate sensitive.
The builder financing wildcard that Parker also identified as one of the bigger factors affecting Georgetown and other parts of Williamson County. Builder financing incentives.
Yeah.
This is the hardest thing for sellers competing with new construction. Parker said he's seeing some Georgetown area builders promote rates near 4.99% through their affiliated or preferred lenders.
So it can be a great opportunity for buyers, but for resale sellers, that can be troublesome.
Well, you talked about leading indicators earlier. Builders are always going to be a great leading indicator because their sales reps are reporting traffic back to the home office. They know they have to liquidate inventory. It's
That's
a
right.
business for them. It's whereas we hear from resale sellers all the time, well, I don't have to sell, right? So you have two different mindsets there, and the builders' incentives are going to tell you a lot about where the market is.
Right.
So those offers depend upon the specific home, the loan program, buyer qualifications, available incentives that they have in their packages, and closing timeline. So the exact terms will vary. Now that creates a very real challenge, as we said, for the resale market.
So a resale home may have a lower purchase price, while the new construction home produces a lower monthly payment because the builder is contributing money towards that financing.
And which one do you think they do?
Yeah.
If you drop the price by 10 grand, what is that per month?
Yeah, I mean,
8, 10 bucks, 15, 20 bucks? The lower monthly payment is going to be felt every single month.
right. And when you have a buyer that can choose a resale home that maybe fits their family a little bit better or the function of the home that they need versus new construction, which is brand new, has the warranties in place, and will have a lower monthly payment, they'll give up some of the functionality.
Yeah, 5%. That's going to be a lot cheaper monthly
That's
payment
right.
than 6.5%.
For some resale sellers, offering a contribution towards the buyer's closing cost rate buydowns can create more value than marketing the same size price reduction in the sales price. And this is exactly why the market can feel so confusing right now.
So two homes with the same asking price can produce dramatically different monthly payments after we account for the interest rate, the property taxes, insurance, seller contributions, closing costs, and builder incentives.
Now, Steve Ferguson with RWM Loans is seeing another side of the current market. So while purchase applications declined, refinance activity has increased 4% during the latest weekly report.
Isn't that interesting?
Right. And that may sound strange when mortgage rates are higher than they were several years ago.
But not every refinance is about lowering the mortgage rate. So Steve is working with homeowners who are using cash out refinances or home equity lines of credit to consolidate higher interest debt with higher interest rates and to renovate their homes or add features such as a pool.
Yeah.
So Steve shared an interesting example. He recently helped a homeowner complete a refinance where the new mortgage rate was more than 4 percentage points higher than the existing rate. That's a big difference. And at first glance, that sounds like it would make no financial sense. But after restructuring and paying off credit card and other short-term debt, that household was able to reduce its total monthly expenditures by more than $1,000, and that gave them money to put a pool in.
That's right. So that doesn't mean that accepting a higher mortgage rate is always a good idea. It means that the mortgage rate by itself does not tell the entire financial story.
Home equity can be a useful financial tool, but it's not free.
It is not free money.
It's borrowed money secured by your property, and the costs and risks need to be evaluated carefully. So Steve's observations may also help explain why some homeowners are choosing not to list.
Yeah. Instead of moving or replacing that 3 or 4% first mortgage with a higher rate, some homeowners are just adding a bedroom or remodeling the kitchen or adding a pool or making their current home work for them for the next stage of life.
Okay, and this brings us to the real market of the moment.
That's right. Finally. We do not have one uniform Central Texas housing market right now.
Nope, it's hyper-local.
That's right. We have at least 3 different markets operating all at the same time.
So first we have the resale market, where buyers may have more choices and negotiating room. Sellers, like you mentioned earlier, are getting antsy about selling
That's
before
right.
summer's over. But the buyers are going to remain extremely sensitive to the monthly payment. Second, we have the new construction market, where builders are using incentives to get rid of inventory. They're going to pull rate-sensitive buyers towards their communities with that. And then third, we have the existing homeowner market, where people are using equity to renovate, restructure, basically taking advantage of the fact that they're already there with a low interest rate, move some of that into a higher interest rate so they can remodel, add a pool, or somehow improve their home. So Tanya, what does this mean for buyers?
It means preparation matters. Do not rely on payment estimates that you received 3 to 6 months ago, not the interest rates you received 3 to 6 months ago. Ask your lender to show you multiple scenarios, including different paydown options, seller contributions, temporary buydowns, permanent buydowns, builder incentives, and also have your agent run scenarios with you so you know what price point you should realistically be looking at.
Okay.
And do not assume that the lowest priced home automatically means the lowest monthly payment. We have property taxes here in Texas. So depending on the financing, and the more expensive home could possibly produce a more manageable payment. Yeah.
The property taxes coming is actually really relevant here because so many neighborhoods have MUDs now, and the tax rate can vary widely between neighborhoods.
That's right.
Okay, so the goal is not simply to find a house. The goal is to find a home and a financing structure that still makes sense after the excitement of the purchase wears off.
That's right.
What does it mean for sellers, Tanya?
It means that the increase in June's sales is encouraging, but it does not mean that every home is going to sell quickly or at any price. You must listen to the market and your reputable agent.
Pricing, presentation, condition, competition, and financing strategy, it all matters. So for you resale homeowners, sellers, don't forget, you still might have a unique selling proposition that beats new construction.
For sure.
That could be as simple as, you know what, my trees are 30 years old, those trees are 6 months old. More established setting.
Lower tax rate.
Yeah, better view. There could be a number of reasons that you're something that a buyer would choose over and above new construction. So don't give up hope. Let's talk about strategy in the big picture.
That's right.
A holistic approach. So the next 30 to 60 days will be especially important. June closings were strong, but the lenders are telling us that fewer buyers may be entering the pipeline right now.
We will be watching pending sales, new contracts, active inventory, price reductions, seller concessions, and days on market to see whether the July slowdown begins showing up in future closing data.
The Central Texas market's not dead,
It's not.
but it is cautious. It's fragmented. It's extremely payment driven. And the biggest mistake buyers or sellers can make right now is assuming that one national headline or even one countrywide statistic is going to be the reason that they should take action.
That's right.
So your strategy depends on your neighborhood, your price point, competition, your financial situation, your timeline, and lest we forget, the whole reason you're moving to begin with.
That's right.
Life happens.
So whether you are relocating to Central Texas or considering selling your current home and comparing resale with new construction, or just trying to decide whether renovating makes more sense than moving, reach out to our team. We will help you evaluate your options and help you make the decision that is based on your situation and that is right for you, not based on some headlines that aren't accurate.
And make sure you subscribe because we'll be back next month to show you whether the current slowdown in mortgage applications actually makes its way to the sales data.